Something unexpected is happening, and it's happening faster than anyone in Washington predicted. For months, Donald Trump has vowed to punish China, crush its exports, and restore American manufacturing strength. But as the numbers roll in, the story looks very different. Instead of shrinking, China's trade surplus has exploded, climbing to 6.4% of its GDP, the highest level in over 10 years. In just the third quarter, Chinese exports nearly touched the $1 trillion mark. Rather than buckling under pressure, Beijing appears to be thriving, capitalizing on the very economic tools meant to weaken it. Meanwhile, the pain from Washington's tariff campaign is circling back home. Prices across the U.S. are climbing, factories are slowing, and new job postings continue to decline. What was once promoted as a show of strength now looks more like a slow, self-inflicted wound. Every tariff aimed at hurting Beijing ends up raising costs for American companies and consumers. Even some of Trump's allies, including figures like Scott Bessent, are quietly suggesting a temporary truce, not to solve the crisis, but to stop the bleeding. Because the longer the trade war drags on, the clearer the reality becomes. China isn't losing this fight. It's repositioning itself for a much larger, longer-term victory that extends deep into America's economic core. Trump's plan was built on the belief that tariffs could rebuild American industry. Yet the data shows the opposite. Since the first wave of duties went into effect, the effective U.S. tariff rate has soared to 15.4%, the highest since the 1930s. Even after shifting to alternate suppliers, the figure barely drops to 14.3%. Those added costs don't vanish. They ripple through every level of the economy, from steel and electronics to food and housing materials. Factories are cutting back on shifts, retailers are raising prices, and consumer spending is slipping. Job listings are now 25% below their 2022 peak, with white-collar hiring still lagging and blue-collar openings shrinking. Add to that a prolonged government shutdown, now stretching beyond 2 weeks. And the result is a fragile economy feeling the weight of its own trade policies. On the other side of the Pacific, Chinese exporters have adapted with remarkable agility. Many have rerouted shipments through Southeast Asia, changing registration codes or shifting ownership structures to slip through tariff loopholes. The result? U.S. import costs keep rising, while China's trade surplus keeps expanding. Even Washington's most loyal policy architects are now discussing an uneasy ceasefire, less as a tactic and more as damage control, because every additional month under high tariffs drives deeper cracks into American supply chains, profits, and market confidence. Trump himself has started acknowledging how unstable this strategy really is. In a recent exchange, he admitted that a combined tariff load exceeding 150% on Chinese goods might not be sustainable, yet he insisted it was necessary to achieve a fair deal. The irony is that while Washington talks fairness, Beijing is busy rewriting the rules, and its latest move strikes not at exports, but at the raw materials that make modern industry possible. China's response has shifted the fight from trade tables to the mines and refineries that power the global economy. Through new restrictions on critical exports, including rare earths, gallium, and germanium, Beijing has targeted the foundation of America's high-tech sector. These aren't minor resources. They're essential for everything from microchips and electric vehicles to radar systems and fighter jets. And China holds over 80% of the world's refining capacity for them. While the US can mine small amounts, nearly all processing happens in China, where costs are lower and regulations looser. Rebuilding that capacity in the West could take up to 7 years and billions of dollars. Already, the prices of essential inputs like lithium carbonate have surged by more than 40% since Beijing tightened export checks this summer. For American manufacturers, that means higher costs and thinner margins. The semiconductor industry is particularly exposed. Despite its 20 operational foundries, the U.S. still depends on Chinese materials for wafer polishing, cooling systems, and specialized metals. If China continues constraining exports, production could slow dramatically. The current AI boom hides this weakness. Domestic demand remains strong, but the balance is fragile. Beijing knows this. Every restriction is a reminder that industrial power begins with control over resources, not just technology or tariffs. The danger isn't limited to the tech sector. Defense manufacturing relies on the same materials, from missile guidance systems to advanced alloys. China's defense industry can already ramp up production 6 times faster than America's under current conditions. Over the next decade, Washington has identified more than 30 minerals vital to national security and clean energy systems, including lithium, nickel, and rare earth elements. Nearly all are mined or refined under China's direct or indirect control. For the U.S., these aren't theoretical vulnerabilities. They're already active choke points. Without access to these materials, key industries, from EVs to aerospace, could grind to a standstill. While Washington continues to target China's AI and tech sectors, Beijing is quietly striking at the foundation of America's industrial capacity. It's not about smartphones or semiconductors alone. It's about the entire ecosystem that underpins U.S. economic strength. And as the pressure mounts, those shocks are now spreading into the financial system itself. What began as a tariff war is morphing into a credit and liquidity crisis. Rising input costs, collapsing margins, and falling consumer confidence are now rippling through Wall Street. A string of quiet bank failures over the past month has shaken investor confidence. The first clear signs that America's economic offensive may be turning into its own undoing. The financial cracks began quietly, then spread like wildfire through America's banking system. When the auto lender Tricolor collapsed into bankruptcy, it left J.P. Morgan nursing a $170 million wound. Soon after, another giant, First Brands, defaulted on $10 billion in debt, shaking investor confidence in the entire private credit boom built during years of easy money. Then came the regional bank shock. Zions Bank and Western Alliance admitted to massive loan fraud losses totaling roughly $350 million. Within days, panic gripped Wall Street. Bank stocks plunged, erasing over $100 billion in market value almost overnight. A slow-motion replay of the SVB disaster, only this time spread across auto loans, consumer credit, and commercial real estate. Rising interest rates turned minor cracks into fault lines. Borrowers who once refinanced effortlessly are now defaulting as payments soar. Meanwhile, consumer spending has fallen sharply. Tariffs have inflated the cost of everything: cars, construction materials, electronics, leaving both households and businesses gasping for cash. When customers stop buying, companies earn less, and loan repayments stall. The result is a vicious cycle of inflation, defaults, and credit stress. The exact scenario policymakers in Washington feared most. Trump's advisors are now pointing to the chaos as proof that the Federal Reserve must act, and act fast. Wall Street's pain has become their weapon, an argument for deep, immediate rate cuts, even if it risks destabilizing the dollar itself. The turmoil has given Trump the leverage he wanted: pressure on the Fed. After months of slowing job creation and rising bankruptcies, the White House now frames rate cuts not as a policy option, but as an emergency measure. Markets have priced in at least a half-point reduction before the end of 2025. Fed Governor Moran is championing a radical shift, from data-driven decisions to forecast-driven ones, meaning the Fed would cut rates before the data justifies it. In the short run, that approach has soothed markets. Stocks are soaring again, and gold has breached $4,300 an ounce as investors rush into tangible assets. But those same rallies hide a darker truth: a crisis of confidence in America's currency. The dollar index has already fallen nearly 9% this year, and analysts warn that 2 additional cuts could send it tumbling even further. For ordinary Americans, cheaper borrowing might sound like good news. Yet a weaker dollar makes imports more expensive, revives inflation, and drives foreign investors out of U.S. bonds. Their withdrawal forces capital into riskier assets, inflating bubbles that disguise a slowing real economy. Trump's playbook is simple: keep markets calm, keep credit flowing, and postpone the reckoning until after the election. But every rate cut chips away at the world's faith in the dollar, and in the U.S. financial system itself. As borrowing costs fall domestically, global trust in American debt begins to erode, triggering a capital shift that's already visible worldwide. Foreign appetite for U.S. treasuries is drying up faster than Washington dares to admit. Japan and China, America's 2 largest creditors, are quietly retreating. 2 decades ago, Japan held nearly 40% of all foreign-owned U.S. debt. Today, it holds barely 13%. China's pullback has been even sharper, from almost 30% in 2011 to just 8% this summer, with forecasts expecting it to dip below 7% by October. This isn't politics, it's arithmetic. With inflation hovering around 3.8% and Treasury yields near 4.1%, real returns barely break even. Add sanctions risk, trade friction, and the dollar's slide, and even close allies are diversifying. Central banks across Asia and the Middle East are stocking up on gold and yuan-based bonds, clear evidence of a structural shift away from dollar dependence. As foreign buyers vanish, Washington turns inward, leaning on domestic banks and investment funds to finance its debt. It works for now, but it traps the risk inside America. If the bond market buckles, it won't be China or Japan left holding the losses. It'll be U.S. pension funds, mutual funds, and regional banks. Behind the scenes, the Federal Reserve has already resumed quiet bond purchases to keep Treasury auctions stable. Yet every new round of intervention deepens global skepticism. To many investors, America now looks like an economy propped up by its own printing press. Once faith in Treasuries weakens, it spreads everywhere, from the strength of the dollar to the reach of U.S. power itself. Trump's economic team now stands at a crossroads. They can slash rates and risk destroying the dollar's value, or hold firm and watch the banking system strain to the breaking point. Either road leads to pain. One through inflation, the other through collapse. For now, Trump is gambling that cheaper money will buy him time, but global markets are already voting with their feet. The dollar is down nearly 10% this year, while gold and oil surge as investors flee to hard assets. Each rate cut erodes a little more confidence in the system once seen as untouchable. The promise that the dollar would always be the world's safe haven is slipping away. Meanwhile, China is standing its ground, maintaining rare earth export limits and rapidly expanding its manufacturing capacity. Its exports continue to climb, and the yuan is showing up in more international trade deals. America's leverage, built on control of finance and energy, is slowly weakening. With record debt, rising inflation, and fewer foreign lenders willing to help, Washington's room to maneuver is shrinking fast. Debt, devaluation, and inflation are no longer distant warnings. They're here, the delayed cost of years of easy money and political brinkmanship finally coming due. What began as a show of strength has turned into a struggle for survival. The trade war meant to restore American power may instead mark the moment it began to fade. So, what do you think? Can Trump still pull off another America First revival? Or has China already taken the lead in the new global economy? Share your thoughts below. And don't forget to subscribe as we continue tracking this unfolding shift in the world's financial order.